Hello, students, and welcome back to the ACE Archive. I am so thrilled you're joining us for today's explainer session. Today, we are tackling a massively important topic right out of your financial management syllabus, the factors affecting working capital requirements. Whether you're gearing up for those Class 12 CBSE board exams or you're just trying to wrap your head around corporate finance basics, this is one topic you absolutely need to master. So let's jump right in and get you perfectly prepped. To make your note-taking super easy, we have a very structured agenda today. Number 1, welcome to financial management. 2, factors reducing working capital. 3, factors increasing working capital. 4, the complete 12 factors. And finally, number 5, exam revision and wrap-up. All right, section 1, welcome to financial management. Before we even look at the factors that change our requirements, we've got to remember what working capital actually is, right? Think of it as the lifeblood of a business. Working capital is simply the everyday money you need for the smooth, day-to-day running of your operations. It's that ready cash that helps you purchase raw materials, pay your employees' wages, maintain your inventory, and meet all those routine, boring operational expenses. If a business doesn't have enough working capital, well, its daily operations basically just grind to a halt. Moving right along to section 2, factors reducing working capital. Let's look at our first major grouping, and you might want to jot this down in your exam notes, the reducers. These are the specific business conditions that actually decrease the amount of working capital a business needs to hold on to. Our first reducer is credit availed. If a business gets a credit facility from its suppliers for goods, a much lesser amount of working capital is required. Why is that? Well, because when suppliers allow you delayed payment terms, your business gets to keep its cash in the bank a little bit longer and use it for other things. For a real-world example, think of a massive manufacturer like Maruti Suzuki receiving supplier credit for auto parts. Because they aren't forced to pay cash upfront immediately, their immediate working capital needs drop. Now notice how directly management skills impact the bottom line here. This brings us to operating efficiency. If cash, debtors, and inventories are efficiently managed, the working capital requirement can be significantly reduced. Imagine a company that converts its inventory into cash super quickly with almost zero waste. A really great Indian example of this is D-Mart. Their fast inventory movement and incredibly quick cash collection from customers mean they aren't tying up unnecessary funds in warehouses, keeping their overall working capital requirements impressively low. Our third reducer is the availability of raw materials. If raw materials are available regularly, without any massive shortages or supply chain hiccups, a firm simply doesn't need to hoard large stocks. And it's pretty simple. Less stock means less working capital tied up sitting in warehouses. For instance, think of sugar mills that are located right next to sugarcane growing regions. Because the raw material is continuously and easily available right next door, they just don't need to maintain massive, expensive stockpiles. Okay, let's flip the script. Section 3, factors increasing working capital. So now we're focusing on the amplifiers. These are the factors that force a company to maintain a much higher level of working capital just to stay afloat. First step on the amplifier side is credit allowed. Now, this is the exact opposite of our first point. A liberal credit policy for your customers results in a higher amount of debtors. When your customers buy now and get more time to pay you later, your cash comes in much, much slower. Because you're sitting there waiting on that cash, your working capital requirement actively increases. Think of a B2B platform like Udaan that allows a lot of local Kirana stores to pay later. To sustain that generous policy, Udaan itself needs to maintain a very high level of working capital. It is absolutely crucial to understand the difference between these two because examiners love to test this. On one side, credit availed means you are getting credit from your suppliers, which decreases your working capital needs. But on the other side, credit allowed means you are giving credit to your customers, which increases your working capital needs. Make sure you lock this rule into your memory. Actually, just star it in your notes right now because it is a very frequent trap in board exam questions. Next up, we have growth prospects. Now, growth sounds like a positive thing, and obviously it is, but it requires cash. If a firm is growing really fast, it's going to require a huge amount of working capital to meet those higher production and sales demands. When you expand, you need more inventory, more marketing, more sales support, the whole shebang. Remember Reliance Jio during its massive rapid expansion phase? To support that kind of aggressive national growth, a truly enormous pool of working capital was strictly necessary. And that brings us perfectly to our next point, the level of competition. In case the market competition is fiercely high, a business is pretty much forced to hold more stock of finished goods. Why? Well, because if a customer wants your product and you're out of stock, they are instantly going to buy from your competitor. No hesitation. Intense competition means you have to guarantee availability. A great example of this is Hindustan Unilever, keeping a vast array of products constantly available across competitive local markets to ensure they literally never lose a sale to a rival. This heavily increases their overall working capital requirement. Our final amplifier is the impact of inflation. When there's inflation, meaning rising prices, a huge amount of working capital is needed just to maintain a constant volume of production and sales. Even if your business isn't growing at all, the rising prices of inputs, transportation, and services mean everything just costs more. Take a company like Amul, for example. If they face higher transportation and milk procurement costs due to inflation, they instantly need more working capital just to produce the exact same amount of butter and milk as they did the previous year. All right, Section 4, the complete 12 factors. So we've done a deep dive into the most frequently tested reducers and amplifiers. Now, let's zoom out and look at the first 6 of the 12 official factors affecting working capital requirements according to your CBSE syllabus. If you're taking notes, now is the time to write these down or quickly grab a screenshot. Number 1, nature of business. 2, scale of operations. 3, business cycle. 4, seasonal factors. 5, production cycle, and 6, credit allowed, which, as we just discussed, acts as an amplifier. Continuing our master list to get the full picture, we have number 7, credit availed, 8, operating efficiency, 9, availability of raw materials, 10, growth prospects, 11, level of competition, and 12, inflation. I can't stress this enough. Understanding every single one of these 12 factors is absolutely vital if you want to score full marks in your financial management long answer questions. So make sure you study them carefully. Finally, Section 5, exam revision and wrap-up. We have definitely covered a lot of ground today, but this right here is your ultimate one-page revision chart. Let's do a really quick rapid-fire recap of those directional rules. Credit availed decreases working capital. Operating efficiency decreases. Availability of raw materials decreases. Now for the amplifiers. Credit allowed increases working capital. Growth prospects increases. Competition increases. And finally, inflation increases working capital. These relationships are tested constantly in board exams, particularly in those tricky multiple-choice questions and case studies. Just memorize the direction of the impact. Now, before we go, I want to leave you with a thought-provoking, high-level application question exactly like the ones you're going to face in your exams. Think about this for a second. How might a sudden rise in inflation, combined with receiving very generous credit from your suppliers, impact a firm's total working capital? You've got an amplifier mixing with a reducer. I really want you to think critically about which factor might actually outweigh the other, depending on the specific industry. Take some time to write down your answer to that question as part of your study routine tonight. Thank you so much for joining me today, students. If you found this visual explainer helpful for your exam prep, please go ahead and hit that like button, share this with your classmates, and make sure you subscribe to the ACE Archive for more clear, structured, and exam-focused CBSE Business Studies explainers. Keep studying hard, stay super focused, and I will see you in the next explainer session.